What's going on, my fellow wealth creators? Matty Ice here. In this video, we are going to talk about the risks of taking a policy loan from your dividend paying whole life insurance policy. If you're using it for something like infinite banking, you're treating it like your emergency and opportunity fund like I do, it can be really, really powerful. I think policy loans are a very powerful tool for accelerating the wealth building process in our lives, because these policies we get multiple benefits from one policy, from one financial vehicle. We're getting our dollars to perform multiple jobs. It's a very efficient savings vehicle, but we need to make sure that we are utilizing the policy responsibly. All right, because just because the whole life policy itself is very, very low to almost no risk, it's in and of itself, because there's guarantees with the policy. That doesn't mean that we can't screw things up and take what is supposed to be a really powerful financial foundation and turn it into a complete nightmare, right? We don't want to be doing that. So I just want to do a quick video breaking down some of the risks involved and how to reduce those risks so that we can use these policies for what they're meant to do. All right, so let me share my screen here and let's get into this. So risks of policy loans, how to reduce them. First, I want to talk about how these policy loans work, just a general overview. Basically, what we're doing here when we take a policy loan is we're borrowing the life insurance company's money, and that comes from the general fund of the life insurance company. So sometimes you'll hear people, usually in mainstream financial media, talk about how it's really stupid to take a policy loan because you're borrowing your own money. You're not. That's just ridiculous. You're borrowing the life insurance company's money. And one of the benefits of doing this is that our money is still growing in the policy. So I'm jumping ahead a little bit here, but we're continuing to get that uninterrupted compound growth within the policy. All we do is pay a little bit of simple interest on the policy loan. So it's really, can be really powerful. All right. The cash value in your policy determines how much can be borrowed. So the death benefit is what's actually used as collateral, but the cash value, think of the cash value as the equity in your home. If you were to get a home equity line of credit, the equity in your home would be used to determine how much of a line of credit you can get. Cash value is pretty much the same thing. That determines how much we're able to borrow from our policy. All right, death benefit is collateralized, which means this is an unstructured loan. And again, this is normally a really good benefit of these policy loans. But if you're not being responsible with your policy and actually paying the policy loan back, we'll talk about that in a minute, that's when we can get into trouble. And with the fact that these are unstructured loans and that we are in charge of how much we pay back to the policy loan, when we pay it off, whether we decide to pay it off or not, because technically you don't even have to pay the policy loan back. But I try to be very, very careful saying that and bring a lot of context, because you absolutely want to pay your policy loan back, even though technically you don't have to, because it's covered by your death benefit. So basically what would happen is if you passed away, whatever outstanding policy loan that you have, the life insurance company would deduct the amount of the policy loan from the death benefit. And then whatever's left over, that's what gets passed on to your beneficiaries. All right. So that's why you technically don't have to pay the policy loan back, but you absolutely want to, because if you don't, depending on the scenario, that's when you can start to get into trouble. But in general, because the death benefit serves as collateral for this loan, it's unstructured. That gives us a lot of flexibility when it comes to paying back the policy loan, as opposed to traditional financing, where if you don't make a payment a week later or 2 weeks later, you're going to start getting phone calls. There might be late payments and penalties, late payment penalties and fees. And, if you have collateral posted, like, if you have a loan on your car or whatnot, you have the risk of your car getting repossessed, whatever, right? So there's none of that with a policy loan. That's again, one of the reasons why these things are so awesome. And like I mentioned earlier, our money continues to grow within the policy. So we're earning compound interest, but we're paying simple interest. And if you watch some of my other videos, I'll link it down below. But the difference between compound interest and simple interest is so freaking powerful, guys. So it's absolutely worth it to pay a little bit of simple interest to continue to get that compound interest in our policy. So really cool stuff. Now, how is the interest calculated on these policy loans? This is really important. So it's simple interest, which means that the interest is applied to the average daily balance. This is really powerful because again, this can significantly lower the amount of interest that we, because the interest rate is being applied to whatever the daily balance is. And to show that, I'm going to pull up a calculator here, but basically the interest rate just determines how much interest is being applied to that daily balance. It doesn't mean that's how much interest you're going to pay over the year. So let me show you an example here. Let me get rid of this. Let's pull up my calculator here. So let's use a very simple example. Let's say I take a policy loan for $100,000 and I have a 5% interest rate on that. Okay. How much interest would I pay over the year? It'd be $5,000, right? However, let's say I'm being a good steward of my money, and the banking system that I've set up here with my policy, I'm going to start paying back that policy loan. Let's say I pay that down in the first month. Let's say I make a $5,000 payment to it. Well, now and actually, you know what? Let me calculate this. So we would pay $5,000 in interest for the year, assuming we didn't make any payments. That comes out to, if we divide it by 365 days, because again, it's applied to the average daily balance. All right. That's $13 and we'll call it 70 cents per day of interest that we're paying on this particular loan in this example. Okay. Now watch this. If I make a $5,000 payment, that now reduces the balance to $95,000. The interest rate is the same. So now on an annual basis, we're paying $4,750 divided by 365 days. Because again, it's applied to the average daily balance. It's not scheduled like an amortized loan. This is very different. All right, now we're only paying $13.01 per day in interest. And as we continue to lower that balance, let's say I make another one. All right, we're going to go to 90,000. Okay, whoops, did that wrong. Let's go back. All right, times 0.5% interest. That's $4,500 on an annual basis divided by 365 days. Now we're only paying $12.32 per day in interest. So hopefully you can see that as we pay down the balance, we're paying less and less interest. And at the end of the year, even though our interest rate might be 5%, that doesn't mean that's what we paid for the year, because we were making payments to and lowering that balance, lowering the principal, which lowered the amount of interest applied to our policy loan. It's awesome, guys. This is why paying a little bit of simple interest to earn compound interest in our policy while we use the money to build wealth makes a lot of sense and is really, really powerful. The amount of interest that we pay on the policy loan is a very small price to pay to be able to get access to the money to build wealth like we normally would and get the compound growth in the policy, right? So anyways, hopefully that makes sense. Let me full screen this again. Now that we understand how the policy loan works, how interest is calculated and all that stuff, let's talk about some specific risks involved with taking a policy loan here. Obviously, it's going to be not paying back the policy loan itself. There's a lot of information out there. You just got to be really careful when it comes to not having to pay back the policy loan. Like, I don't think anybody's intentionally trying to be misleading, but when you say that as one of the benefits, you don't have to pay back the policy loan and you don't give any additional context and I guess a warning as to what the consequences of that would be. Well, now it's just a little bit misleading, not intentionally, but it's misleading because that can inject a lot of risk into the policy. Even though, again, the death benefit would cover the policy loan if we passed away, we do want to make sure that we're paying back the policy loan. Here's one of the other reasons why is that the interest can actually compound against you. All right. So in the example I was just giving, if we didn't pay the policy loan back and we had the $100,000 balance and we paid the $5,000 of interest, well, that gets added to the policy loan. Now we're paying the next year, we're paying 5% on a $105,000 loan balance, right? So this can work against you. And the thing is, we want to be earning compound interest in our policy, not paying it on the policy loan. So at the end of the day, as long as you're paying back the policy loan, don't really have to worry about this. All right. But I just want to make this very clear because this, if it compounds against you and you don't have enough cash value to cover the policy, cover the interest, you could end up lapsing the policy. You lose all the benefits. You lose the money that you put into the policy, not to mention you could potentially have a massive tax consequence as well. So you want to be really careful. The other risk is that the policy loan can add to investment losses, unfortunately. So as an example, if I take a policy loan, all right, I'm paying simple interest on that. That's fine. But let's say I invested in, the latest cryptocurrency project that's going to be the next Bitcoin or something like that, it's probably not a really good way to utilize the policy. We want to be careful with stuff like that. And if I end up losing that money, well, now I've lost the money, plus I have interest that I need to pay on the policy loan to make sure that my policy doesn't lapse, right? Now, the counter argument to this is that over time, even though it's adding to the investment losses, that the compound growth of the policy will help to make up for those losses. But it's still not a great scenario, but that is something to be aware of, and why we need to be very strategic about what we're using the policy loan for when it comes to building wealth. I like to, one of the things that I say is that really we are the biggest risk to our policies, like when it comes to taking policy loans and things like that, because it's what we do with the policy loan that's going to dictate what happens to our policy long term, right? And our ability to, whether or not we're paying back the policy loan itself, right? So we want to, because our policy is going to do what it's going to do, even if we never use it. It's going to get that uninterrupted compound growth. We have death benefit, living benefits. Like, the policy itself is not risky, right? It comes with guarantees. But as soon as we start messing with the policy, well, now that's when risk can be injected, and we just want to be careful. How do we reduce those risks? That's what we'll finish up with here really quick. I like to keep things pretty simple, guys. It's increasing financial education, understanding different wealth building strategies. As an example, and I'll just preface this by going to the second point here. Don't invest in things that we don't understand. That can significantly reduce our risk when using these policy loans. We don't want to invest in things that we don't understand, and we're just chasing the highest rate of return. We want to make sure that we're utilizing our policy to build wealth in things that we know, like, and understand. All right. As an example, one of my favorite ways of using my policy is private money lending. I love it. It is awesome. It's literally replicating what the banks do. And so I borrow against my policy, and then I lend it out at a much higher interest rate than what I'm paying on the policy, and creating positive arbitrage. I keep the spread, right? But I didn't start doing that. I took 6 months of educating myself, buying courses, talking to mentors, hiring coaches, etc., learning the process, increasing my financial education, really getting a good understanding of how private money lending works before I ever even considered, before I ever even started looking for property to lend on, and started networking or anything. I was just straight up educating myself for 6 months straight until I was comfortable with the terminology. I understood the process start to finish. I'm not an expert at it, so still have a lot to learn, but I knew enough to go ahead and pull the trigger, and it's been awesome. About to close on my very first loan here in I think it's 4 days. So it's really cool. So, and also, guys, I want to mention, don't use the policy for luxury expenses. We're not setting these things up for, to take vacations and buy depreciating assets. With that said, this is a great way to make large capital purchases, like buying cars and things like that. But my point is, we typically want to make sure that we have our mindset right before we set up a policy and start taking policy loans, because this is a wealth building strategy. It's not, like, I see people talking about using this to buy groceries and stuff like that. I'm like, is that really why we're going to be setting up policies? For me, that's just not a very good idea. We want this to accelerate the wealth building process in our lives. So, conclusion, policy loans can be an excellent tool for building wealth when used properly and responsibly. If you, if you take a loan from the bank, would you not pay the bank back? No, probably not. There's going to be some pretty big financial consequences to doing that. Well, if that's the case, then why would you not pay your own bank back? If we're using this as a banking system, we want to be our own responsible bankers and make sure that we're paying these policy loans back as quickly and efficiently as possible, and utilizing them to do what they were intended to do, in my opinion. That's accelerate the wealth building process. So anyways, I hope that helps, guys. If you have any questions, drop some comments down below. I'd love to hear your feedback as well. Make sure you check out all the links in the description for additional tools, training, and resources when it comes to infinite banking, using dividend paying whole life insurance to build wealth, private money lending, all that good stuff. Lots of tools, training, and resources for you in the description. Make sure you take advantage of them. All right. Hope you guys are crushing it, and I will talk to you in the next one. To your success, Matty Ice is out.